my name is James King, and this is my final presentation for Dr. Spradley's corporate finance course. I've gone over the 3-minute mark about 5 or 6 times that I've tried this. I'm really going to attempt to just hit the highlights. I'd like to start out in immediate implications of ratio analysis. Overall, Goldman Sachs does very well. They have a good operating margin, they have a good profit margin. They have a consistent way to somehow guarantee that they come out on top given the large amount of debt that they hold. This is a big strategy at Goldman Sachs. They hold a large amount of debt to fund a large amount of assets. We see that also reflected in the total debt to capital ratio of 4.17. This is too far below the industry average, I think. In the short term, this really does compromise the amount of capital that you're able to receive, and I think this is something that they should consider, potentially divesting from their bond fund or finding some way to lower expenses. We see the same thing in ROIC. This is talking about how efficient a company is at allocating capital to the right places. Again, 2.98 is considered poor by any metric that you want to look at, and this is something that does not bode well for the long-term growth of the company. I would recommend the same strategy there, maybe some way of reducing the amount of expense that they're putting in that is then compromising their capital. Their basic earning power is not great as well. It's talking about how well a company creates income from assets. I think this is something that they should work on as well in the short term and certainly in the long term. And speaking of the long term, I'd like to go ahead and move to that now. Total debt to capital, I think that, again, if we're looking at a continued worsening ratio, we're talking about lower profit margins, lower return on invested capital, and less interest, frankly, from stockholders, shareholders, people buying the stock. For ROIC, I think they would do better to average around 5 or 6%. I think they could strategically reduce debt by, again, lowering those expenses, finding a way to reduce operating costs. They could do a great job at maintaining that fair or long-term growth, as they go. We looked at Morgan Stanley as well. They outperform Goldman Sachs in a couple of ratios, nothing really key. They do pretty well in things like times earned interest and the market book. Market book's actually one that they both do very well, and one that we're going to use here in just a second in the stock valuation. We see both stocks follow the DJIA with that dip in 2020 coming back up as investors were more confident in investing in the market once that stabilized. We see since Goldman Sachs is a growth stock, I use the stock valuation, or excuse me, since Goldman Sachs is a growth stock, I use the free cash flow method to evaluate that stock. Came to the conclusion that there was a slight 0.29 decrease in the slope. However, given that a lot of that debt, a lot of those expenses, those flows are in fact reinvestments, I supplemented that with the market book ratio and the price earnings ratio. Specifically, I think the market book ratio is interesting because at 10.65, this is significantly above the industry average and shows there's a significant amount of interest from investors that are wanting to invest in this company. That ratio is trending up. I therefore think the stock is underpriced, and my recommendation is to buy. Thank you.